Yo, what is good, guys? Jerry Trades here, back with another video. Today it's just gonna be my day 4 class. I was supposed to do this today on Discord, but my internet went out. Discord is being glitchy, so I was gonna do it on Sunday, but some stuff came up, so I'm just gonna do a recorded class for today. And then if you guys have any questions, you guys can always just add me in the Discord. Of course, there's nothing wrong with that. I'm just like a lot of stuff came up in the last couple hours, so it's nothing like too worrying. It's just like some stuff I have to take care of, and it's gonna take me a while. So I don't think I'll have time on Sunday, and then I'm just going back on school on Monday. So yeah. So let's just get into it. Understanding entries, right? What are entries, right? Entries are basically just narrative combined with bias, right? Because your bias is your draw on liquidity, understanding where price wants to go, and then narrative is understanding where price is going to deliver from, and that's imbalances, PDRAs, and then the actual entries is where you believe price is willing to deliver from, and 2 to get to your draw on liquidity, right? So my 2 entries, these are basically the 2 entries I use. Basically only 2 types of entries generally, right? We have reversal entries, which is trading the formation of a protected swing, right? After when we talked about protected swings in the first class, you know, that's a purge into a key level with a change in state delivery. It doesn't have to be a change in state delivery, it can be a market structure shift. But it creates a protected swing, right? Because a protected swing is a purge into a key level and then a change in state delivery, which is a reversal, right? You're tapping into a level where you expect price is willing to, where smart money is willing to buy, and you know, and when they buy, it creates that reversal, right? And then continuation is understanding in the phases of price, right? The 4 phases of price are continuation, reversal, expansion, and consolidation, right? In healthy expansions, we will have retracements, right? Because markets can't expand forever. So what do we need to do in order for the market to expand for a good amount of time is obviously to allow some retracements, right? To allow, you know, orders to be filled from imbalances, or for smart money to be able to buy at a discount when price is already rallying a lot, right? So that's my continuation. That's basically a continuation entry. So my classic reversal entry focuses around the classic AMD, which is accumulation, manipulation, and distribution. So the main thing I'm looking for in this reversal, right? This is really only one possible scenario, right? So the reversal entry, what I framed the reversal off of is the range of New York session. So I'm looking to catch the high or low of the New York session, right? So when looking for continuation entries, it's much more high probability, right? Because we'll talk about continuation entries, but if you think about it, right? If I'm in a continuation entry, I would have a weekly protected low, a daily protected low, a session protected high low, or the high low of New York session, and then so those 3 protected highs and lows. And as you remember, what I talked about, protected highs and lows are protected by other protected highs and lows, basically. So it forms that like kind of like stair formation. So basically, protected high or low, I trade New York session. So if I'm bullish, I want the low. If I'm bearish, I want the high. And key highs and lows is where protected key highs and lows are formed when smart money buys or sells at what they consider a good price, right? Smart money wants to get in the best possible position, so that's the best price and the best fill, right? So that's what we were talking about with opening prices, right? If we're above the opening price, that's a premium, that's where you want to sell, and if you're below the opening price, that's a discount where you want to buy, right? And it also traps a lot of buyers and sellers because when they see a move lower, they all think, oh my gosh, we should short, right? But smart money wants to buy, and so smart money uses their positions, right? They're using their short positions to fill their buy positions, and that's what makes it into a good discount, right? And then they're moving price higher, right? So rules, right? Very simple. I don't believe in overcomplicating trading. I believe that your higher time frame buys should carry the majority of the load, and then your entries are just, you know, narrative, right? So key levels, right, has to be in balance or high or low. That's greater than the 5 minute. or equal to. So if you do the 5 minute, the 15 minute, the 30 minute, the 1 hour, the 4 hour, the daily, the weekly, right? It can be all those. Has to be a Judas swing of the key open, right? Because that's where smart money wants to come into play. So key opens, right? 8:30, New York Kills an open. Also, most of the high impact news, the very high impact news, right? 8:30 high impact news is usually much stronger than like 9:45 or 10. Red folder news, so 8:30 news, very, very strong. 1 minute change in state, so once we purge it to a key level, it's a 1 minute change in state. Stop loss, right? So my stop losses are either below the protected swing or below the body of the order block. It really depends on my risk to reward. Sometimes I like, sometimes it's already high enough risk to reward to where I'm cool letting the low be my stop loss, but sometimes if it's a little tighter risk to reward, I put it at the body of the series of down close candles that gives me the change in state delivery. So that's something that you guys have to kind of like play around with yourself. Do you want to have a lesser RR, but you might have a higher win rate because the trade has more room to breathe, or are you cool with higher RR, but there's a chance you get stopped out? Now with the body of the order block, sometimes if you do get stopped out, that's okay, right? You can just re-enter off of a propulsion block, and that's a big thing with these stop losses. The protected swing, right? You're gonna have to make a new order block, but if you get stopped out below the body but not the wick, you can still get a propulsion block entry, right? But ideally we don't trade below 50%. So yeah, so stop losses uncommon. These stop losses are usually caused when I don't have the best RR, and usually if I don't have the best RR, I'll wait for the retest, or I'll wait for the continuation. But sometimes I do take it. The primary one I use is the mean threshold of the order block. Ideally in a bullish situation or in a strong narrative situation, right? We should not be trading below 50% or very below 50% in an expanding market. So I usually pair this with fair value gaps and failure swings, right? So for example, if we have a fair value gap that creates the order block and it's slightly below the 50%, I'll put it slightly below the fair value gap and the 50%, right? So I'm using the 50% as kind of my guideline, and then the fair value gap as my actual, like, where my stop loss is going to be, and below a failure swing. So sometimes we purge into a key level, we don't get the change in state delivery, but then we make a higher low, so we purge into a level, and then we move up, don't quite get the change in state delivery, and then we move down a little bit and then come back up. I'll put it there. Once again, I'll use the mean threshold as my kind of guideline. So pros and cons, right? So with the reversal entry, it's very early into the session, right? So that means you can get in with all the volatility, right? So it's usually faster moves, higher risk reward, right? Because your stop loss is pretty small and you still don't really know. You're still at the very beginnings of the range formation, New York session, so you have a lot more of that potential range that you can trade into. And then you have a small stop loss. Because you're entering out reversal, there's really not much to anchor your stop loss other than like the lows that get formed off of your reversal, off of the potential reversal. Cons, lower win rate. It's not a super low win rate, but it's definitely a lower win rate compared to the continuation entries. And then you can also be stopped out quickly, especially if you're wrong by your bias, because it's very likely you could be entering within retracement of a bearish trend. So for example, if you thought you were bullish, but the actual trend was bearish, there's a very good chance you're entering off a retracement on that. And that can, be stopped. You can be stopped out very quickly on those situations. And it can be very psychologically draining because you want to go for a reversal, it's a retracement, bang, you get stopped out, another retracement, bang, you get stopped out again, and losses can pile up a lot. So continuation setups, the idea behind it once again is expansion, right? In a good expansion, we want to see retracements, right? Price cannot expand forever. In order for price to expand for an extended amount of time, smart money will buy at discounts, which are retracements, right? Phases of price, expansion, retracement, expansion, retracement. That is the idea of market maker models, right? And how we have the sell side of the curve. So in the market maker buy model, we have the sell side of the curve, and we have the buy side of the curve. So you have your lowest buy, right? That's kind of like your reversal. And then you have your first stage accumulation, and then second stage accumulation, right? Reaccumulation, you have those continuation entries, and that's usually the basis of retracements, right? Similar rules, right? Key level greater than or equal to a 5-minute, high or low, or an imbalance. We already have a confirmed reversal, so we need the reversal setup to play out first, right? And then we have a 1-minute change in state, confluence, another key open. So sometimes, especially on days when you have multiple key opens, so the most high probability one is 8:30 red folder news reversal, and then 9:30 continuation. So 8:30 puts in the low of New York, and then we move higher 9:30. So it's very similar. It's another Judas swing, right? We Judas swing lower, and then we tap into a 5-minute or above and get 1-minute change in state. Similar, very same stop loss placements. And then the pros and cons. Pros, it's a much higher win rate, right? Because just like how I said, there's a weekly protected high or low, there's a daily protected high or low, and then you got your session high protected high or low. Cons, lower RR, right? It's just classic, right? You have already expanded some of the range. You have already expended some of the range, confirming that reversal. So that is a trade-off that you get with the higher win rate, and you're often entering at an unfavorable price, right? Because in expansion price, you very rarely trade back into a discount. Of course, that is the high probability one, high probability setups, and you're going to get the best RR in the low RR situations, but you got to be okay with entering in a premium, right? So key confluences, not going to go too in depth with this. Most of the stuff I've already talked about. Macros, right? We talked about macros in our time and price theory, right? Just they're designed to run imbalances and deliver to liquidity. SMT, right? Not going to explain SMT too much. It's already a pretty common factor. SMT is basically a divergence of correlated assets. So the ones I use are NQ and ES. You can also use YM, right? I don't use RTY. RTY, which is the Russell 2000, doesn't have that well of correlation with NQ, ES, and YM. If you want to use, I only personally use two because I don't really see SMT as too big of a part of my trading. If there's no SMT, I'm still taking the trade anyways. But YM is, I've seen people use YM with SMT, with ES, and NQ. Personally, I think that's just trading on 3 assets is just kind of a lot. And, I kind of just see it as a confluence. Ideally, the asset that's stronger or weaker, it's basically the one that creates, the failure swing instead of sweeping on either side. So bearish and bullish. The asset that doesn't take out the low or high is ideally the stronger one. So ideally you want to, long or short that asset. But personally, I only trade NQ, and I haven't really noticed too much of a difference, right? But just SMT in general is a pretty good confluence. Liquidity levels, right? So this can be a draw on liquidity, or it can also be like a sweep. So it can be either you target it and it's a very strong target, or draw on liquidity, or you trade this as a liquidity sweep, because these liquidity points often have more actual liquidity below them, right? Previous session, previous anything, high or low. So it could be previous session, previous day, previous month, previous week, previous year. It doesn't matter, right? And the idea of that is a swing point, right? In a swing point, the more time it takes shows the greater amount of sellers or buyers defending that area. Once again, as I said, right, a swing point or any liquidity point is caused because buyers or sellers overpower the opposing group in that location, and the bigger the time frame is, the more buyers and sellers are in there, right? So obviously there's going to be more buyers and sellers within that weekly swing point than a daily swing point. Relative equal lows, relative equal highs. These I use more of a strong draw on liquidity, but also you got to understand relative equal lows, relative equal highs. To retail traders, look at support, and they place their stop losses below that or resistance, and then price wicks up a little bit, takes out all their stop losses, moves up, right? And then data wicks, they're very imbalanced areas, right? So kind of just think about them as an imbalance that wants to be filled, right? And as within imbalance, you can obviously move lower as well. And then imbalances, we got new week opening gap, opening range gap, RTH opening range gap, and then we got new day opening gap. I also went over this in my time and price theory class, as they are time-based levels, right? So basically, they are very strong draw on liquidities, right? new week opening gap and new day opening gaps are basically always filled. It's very rare that they don't, but when they don't get filled, they're very strong draw on liquidity. And then open range gap, obviously, if we're bullish, I talked about this on how it's just like a normal fair value gap. If you're bullish, you want the price to fill it, right? And if you're bearish, you want to use it as, as a way for price to go lower, and then vice versa. And ideally, we use 50% on most. Remember, 50%. In a truly expanding market, we should not be trading anything ideally below 50%, right? And then double purge, right? This is a concept I learned from the MMXM trader, and he has a really good video on this. Basically, it takes the idea of liquidity sweeps, right? So if we're bullish, right, we want to see price take out. We want to see price take out a high, right? So it's basically the high or low based off of your based off your bias, right? So if you're bullish, you want to see a high gain takeout. If you're bearish, you want to see a low gain taken out. And basically what that does is a lot of people think that's a liquidity sweep. So if we're bullish, right, and it's high gets swept, a lot of people are like, oh my gosh, this is a liquidity sweep, we got to sell, right? And then once again, smart money is using their orders to enter their buy orders, and it generates liquidity at the very top. But so if you want to learn more about this, the MMXM trader has a really good video on it. I highly recommend it, and it's not a too difficult concept to understand. It's very dependent on bias though. And then your lower time frame market maker model, right? So this is where it gets a little confusing. I'm gonna try to break this down as best as I can. So in reversal trades, it's very simple, right? From a 5 minute or above higher time frame PD array into a 1 minute change in state delivery. That 1 minute change in state delivery is a market maker model, right? Because a market maker model is just the high or lows that gets created while trading into a point of interest, right? So that's your classic market maker model. Now with continuation trades, it's kind of like that, right? Because continuation trades also have to retrace into a PD array, so that retrace can have higher lows on it, right? So that can be a market maker model. However, sometimes the reversal range is not fully taken out, and the continuation targets, the continuation is just a reaccumulation or redistribution, right? So I'll explain that on the charts, and sometimes we do get both, right? But I'll explain this on the charts because it's a lot easier when you guys see it. So this is basically what I'm talking about. So credit to 11 Trades on YouTube for this schematic. I really liked it, so I'm giving him credit for it. So this is a 4 hour, this is a 15-minute chart, and as you can see, we have the change in state delivery, so that can be our daily profile. And then as you can see, we trade lower, and we have this on the lower time frame, right? So that's basically what I was talking about. This is a reversal, right? And then this is our reversal, and then this is our continuation, right? Sometimes in the continuation, we retrace pretty far down, right? And that can create multiple higher engineered liquidity. So this can be a market maker model right here, or this can be a market maker model inside of, a more external market maker model, right? So the sequence is very simple, right? So entry on the 1 minute, reversal, continuation, target the entries, market maker model as a smart money reversal. And then if you're in the continuation phase, you want to finish targeting the reversal, protected lower highs market maker model. And then you want to target 15-minute and 1 hour draw on liquidities. So this is the sequence, right? This is the review of everything we talked about in this class. Weekly profiles, right? Our main protected swing is our weekly profile. As we talked about, you want to trade away from the weekly protected swings, and our weekly low / high is the strongest one, right? And then obviously the day, you want to see based off of what London and New York do. We want to see what kind of daily profile plays out, right? And then sessions, right? That's basically similar. And we have continuations, right? So session profiles, right? This is what we talked about. You can pause the video, but this kind of goes over like what profiles, right? And then homework, right? Just kind of study what I talked about. And so we're going to get into the charts, kind of explain the continuation versus reversal trades, market maker models, and then we're going to kind of go over. So we're going to go over Friday's price action because I feel like it's a pretty good one. We're going to do this on NQ. So I already have some stuff marked out for next week. I can explain that as well, but so on Friday, right, we trade up, right, and we kind of tap this new day opening gap, right, and we move lower, right, and we already have a pretty bearish weekly profile, given that we swept out these highs, right, and we have a change in state delivery. Swept out these highs, change in state delivery. This high is still intact, so this high is still protected. Move lower, right. London takes out Asia highs. Right here, we have a change in state delivery. So our daily profile is set. So we can kind of go over. So I might as well go over everything that we learned about and kind of explain Friday's trades. So might as well. So we take out this low, this high, right? We take out these relative equal highs, and we move lower. 1 hour change in state, right? That's how we confirm our weekly profile. And then so this is a midweek reversal, right? And also FOMC manipulation, right? FOMC gave us the most of the displacement higher, so we can manipulate these highs. Then we move lower, right? And then since this high is still protected, we have that Wednesday midweek reversal idea. And then we move lower, right? And then we take out Asia highs here. And then we can drop down to the 15-minute time frame, right? So Asia highs, we tap into the new day opening gap right here. It's right here and right here. We tap in, right? Since we're bearish, we don't trade above 50% clearly, and we move higher. 15-minute change in state delivery is here. So that is our daily profile. We expand lower in London, right? And then we can kind of see our key opens doing their job, right? And New York 830, we manipulate higher, taking out this high, right? So we take out this high, we take out that high, we drop down to the 1 minute, right? So we have our change in state delivery right here. Right, so this is our high of New York session, and then this is what I was talking about. 830 manipulates higher, 930 continues, right? So what do we see on the 5 minute, right? We can see we take out this high, and then we have another change in state delivery right here. So we have a change in state delivery right here. So this is our continuation, right? Reversal, putting our high of New York session, and then we have a continuation, keeping this high intact, and we move lower, right? So when I was talking about in our market maker model, right, clearly that this entire range right here is our 1 minute market maker model off of the reversal. But then as you can see, when we had the continuation, since we retraced so high, we have engineered liquidity here and here. That's not part of this market maker model, because this is the sell side of the curve. This is the buy side of the curve. This is the sell side of the curve, right? But in this lower, more internal market maker model, this is our buy side of the curve, and this is the sell side of the curve. So that's what I was talking about, how sometimes in continuations we have their own market maker model, but still within more external reversal market maker model, right? So that's basically all I wanted to talk about. Sorry for anyone that got excited or was looking forward to this class. Once again, had some stuff outside of my control, but once again, things obviously don't work out always. So going into next week, I'm not really too sure what we're going to do next week. I think I'm honestly bullish, but I really need overnight session to confirm, right? Because we do have SMT with previous week's low, but we don't really have any changes in state deliveries that I find are relevant, right? We still respected this 1 hour bearish for value gap, right? In order for me to honestly start looking bullish, I want to see price at least inverse this 1 hour gap. But we do have a lot of engineered liquidity on NQ right now. We have all these highs stacked on top of each other, right? We have these two highs and then all these highs over here, and then we also have 4 hour imbalances, right? This 4 hour unfilled for value gap. we have this 4-hour high, we have these 4-hour relative equal highs, which are also 1-hour relative equal highs around here, and then we have all-time highs. So I think that it'll be a good opportunity for us to buy, right? We can be buying in a discount. So honestly, I do want to be bullish next week, but I will take what the market will give me. Honestly, it is very likely that we could just fill in this gap and just move lower, right, into these lows, right? But we're gonna wait for us to see. So once again, I'm truly sorry for all of the stuff with the live class today. Hopefully this YouTube video makes up for you, makes it up. And if you guys need me, you can always at me in the Discord with any other questions or concerns. But once again, I just want to thank you guys for watching. Make sure to like and subscribe, and I'll see you guys next time. Peace.